Imagine doubling your adjusted net profit to 2.33 billion euros in a single quarter, right in the middle of one of the most unpredictable commodity markets on Earth.
Yeah, it's wild.
It really is. I mean, Q2 2026 results are officially in, and Eni just delivered a staggering, massive beat across the board. If you look at the top line, sales from operations just crushed expectations, coming in at an incredible 24.37 billion euros for the quarter.
And, the momentum we're seeing there, it carries straight through the entire first half of the year.
Right.
If we look at the pro forma adjusted EBIT, which strips out all the accounting noise to show us their true operational performance, they hit 8.9 billion euros.
That's a huge number.
It is. And cash flow from operations, or CFFO, is sitting at an incredibly healthy 7.3 billion euros. But I mean, what sent a real shockwave through the market today are the massive guidance hikes.
Oh, yeah, the revisions.
Exactly. Management didn't just tweak their projections, they completely overhauled them. The full year 2026 underlying oil and gas production growth target was hiked to around 5%.
Up from what, like 3 to 4% originally?
Yeah, up from that 3 to 4% band. And more importantly for shareholders, the share buyback program just got a 20% expansion, bumping it up to 3.4 billion euros.
Wait, 3.4 billion?
Yep. That is more than double their original baseline guidance.
That is just, I mean, if you were managing your own retail portfolio or even just tracking the broader energy sector, you have to be asking the core analytical question right now.
How are they doing it?
Exactly. When macroeconomic volatility is just chopping up other players, how exactly is a legacy energy major doubling its net profit and hiking shareholder distributions this aggressively?
Right, it doesn't seem to add up at first glance.
So that is our mission for this deep dive. We're going to completely tear down Eni's Q2 earnings report. We need to look at segment performance, map out the margin profile, and parse management's commentary to figure out exactly where this cash flow is originating.
And more importantly, what specific risks are hiding on their balance sheet?
Yes, the risks. Because doubling net profit requires a really powerful catalyst.
It does, and in this report, the catalyst is undoubtedly the exploration and production segment, E&P. This is the primary cash-generating engine that basically funded the entire headline beat.
Okay, so let's get into the E&P numbers.
Right, so E&P generated 4.77 billion euros in Q2 pro forma adjusted EBIT.
Wow.
Yeah, and to put that in perspective, that represents a 42% increase year over year.
A 42% jump in a single year for a legacy drilling business. I mean, that's massive.
It really is.
I understand, like, a software company scaling that fast, because it's just code. But extracting physical resources from the ground, what is actually driving that kind of operational surge?
Well, it comes down to a deliberate intersection of volume growth, geographic mix, and just brutal cost discipline.
Okay, break that down for me. Start with the volume.
On the volume side, total production climbed 7%, hitting 1.79 million barrels of oil equivalent per day, or BOED.
So they're just pumping a lot more.
Pumping more, but smartly. They aren't just squeezing aging wells. They are bringing entirely new high-margin projects online in places like Norway, Congo, and Mexico.
Oh, I see.
And at the same time, they're starting up fresh production in Angola.
But when the report mentions, cost discipline and geographic mix, how does that actually play out in the field?
What do you mean?
Like, are they simply slashing operational expenses across the board, like firing people? Or is there a structural shift in where they are choosing to pump?
Oh, it's entirely structural. The geographic mix matters immensely because not all barrels of oil cost the same to extract, right?
Right. I guess drilling in the deep ocean is pricier than shallow land.
Exactly. So by focusing their capital expenditure heavily on regions where the lifting costs are lower and the infrastructure is already optimized, the profit margin on every single barrel expands.
That makes a lot of sense.
But the real story for long-term investors, assessing the viability of this company is the future pipeline. In just the first half of this year, Eni added over 1 billion barrels of oil equivalent in newly discovered resources.
Wait, 1 billion barrels in 6 months?
Yeah.
That is a staggering replacement rate.
It is, and it was primarily driven by major new discoveries in Côte d'Ivoire and Angola, so they're replacing what they pump at an incredibly aggressive rate.
Okay, but reading through the granular details of the financial statements, a pretty glaring contradiction jumped out at me.
The impairments.
Yeah, exactly. They took some pretty heavy impairment losses this quarter, massive accounting write-downs on certain oil and gas properties. If production is surging and they just found 1 billion new barrels, why take a deliberate heavy hit on the books?
It's a great question. Impairments often trigger alarm bells for investors, but in this specific macro environment, it is a highly strategic capital allocation maneuver.
So it's on purpose.
Very much so. Management is actively reevaluating their entire global footprint. They looked at future phases of marginal, lower return properties and simply decided to pull the plug.
Just cut their losses.
Right. They are taking the accounting hit today to free up capital, stopping the financial bleed on average assets so they can funnel every available euro strictly into core, high-margin projects that actually fit their 2026 strategy.
Think about it like managing your own retail stock portfolio.
Sure.
Sometimes you look at your holdings, realize a few stocks are just dragging down your overall return, and you make the hard choice to sell them off.
Right. You take a small capital loss, trim the dead weight.
Exactly. You trim the dead weight and redeploy that cash to double down on your absolute best performers to let them run. It sounds like Eni is just pruning the dead wood out of a massive global physical portfolio to improve the overall yield.
That is a perfect analogy. The underlying math backs that up completely. By concentrating capital only on the highest yielding assets, you amplify the returns on the capital employed.
Makes total sense.
And you can see this exact let the winners run philosophy, validating itself in their global gas and LNG portfolio, the GGP segment.
Okay, let's look at GGP.
GGP's Q2 adjusted EBIT came in at 0.50 billion euros, and that represents a 46% increase year over year.
Generating €500 million from gas is really impressive, but, the global LNG market has been incredibly chaotic lately.
But very volatile.
Right, with shifting demand and pricing volatility. So if they are letting the winners run, how are they optimizing the gas side of the house to avoid all that volatility?
By aggressively high-grading the portfolio. They aren't just selling gas on the spot market and hoping the daily price holds up.
Because that would be way too risky right now.
Right. Instead, they are structuring long-term strategic dominance. A textbook example detailed in the report is the newly established Syrah joint venture with Petronas over in Southeast Asia.
Syrah, why does a joint venture in Asia matter so much to a European energy major's bottom line?
Because of proximity and rapid monetization. The Syrah JV instantly positions Eni as a premier regional player in the Asian LNG market.
Which is growing fast, right?
Exactly. That is where the heaviest future demand growth is projected globally. But more critically, Eni recently made massive gas discoveries in the Kutei Basin.
Okay.
So instead of figuring out how to build the infrastructure to ship that gas halfway across the world back to Europe, this joint venture gives them an immediate local corporate vehicle to monetize those Kutei Basin assets right in their own backyard.
Oh, wow. So they find the gas in the region, and they immediately build the corporate structure to sell it in the exact same region, cutting out all the logistical friction.
And securing the cash flow, which is the key. The report highlights that they used this position to lock in long-term LNG supply agreements.
Like actual multi-year contracts.
Yes. We're talking about securing 2 million tons per annum from Indonesia's South and North Hub projects. By locking in these multi-year contracts, they effectively insulate that 0.5 billion euro EBIT from the wild daily price swings of the spot market.
That's incredibly smart. But, generating all of this optimized cash from legacy oil and gas creates a totally new strategic problem.
What to do with all the cash?
Exactly. What do you do with all that cash in an industry that is actively being pressured to pivot away from fossil fuels over the next 3 decades?
Right, the energy transition.
That brings us directly to how Eni is allocating capital into its transition businesses.
And the interesting thing here is that the legacy business is entirely funding this transformation. The data shows those transition satellites are no longer just greenwashing concepts. They're starting to pull serious financial weight.
Let's lay out the scale of that growth for the listener. Plenitude, which houses their renewable energy generation alongside their retail gas and power operations, they delivered a Q2 adjusted EBIT of 0.23 billion euros.
Which is huge.
Yeah, that is a 70% increase compared to this time last year.
That is a remarkable growth rate. But we also have to look at Enilive, their sustainable mobility and biorefining arm. They more than doubled their earnings this quarter, hitting 0.29 billion euros.
A 70% jump for Plenitude is staggering, but I really have to push back on that metric a bit.
Why is that?
Well, when a legacy company's subsidiary grows 70% in a single quarter, it is usually because they started from a tiny baseline or they had some sort of one-off accounting benefit. Is that kind of exponential growth actually sustainable for Plenitude?
It is a really vital question to ask. The 70% jump does reflect the scaling phase when you are building new infrastructure from a smaller base. The year-over-year percentage comparisons always look massive.
Right. It's easier to double from 1 to 2 than 100 to 200.
Exactly. However, the report strongly indicates this is driven by actual operational scaling, not just accounting quirks.
Like physical projects.
Yes. They are continuously bringing new physical renewable capacity online, like their recent solar projects in Spain, while expanding their retail customer base simultaneously.
Okay, so the growth is real.
It's real. That said, sustaining a 70% growth rate indefinitely is mathematically improbable. What matters to investors is the underlying profitability of those new megawatts once the growth rate inevitably normalizes.
Speaking of accounting, though, the report details a major structural change coming up for Plenitude. Eni's planning to deconsolidate Plenitude in the third quarter of 2026.
But keeping a majority stake.
Right, they're going to hold on to a 65% equity stake. But honestly, whenever I hear the word deconsolidation, my radar immediately goes up.
A lot of people feel that way.
Is this just financial engineering? Moving liabilities off the parent company's balance sheet to make Eni look leaner? Or is there a genuine operational advantage to cutting Plenitude loose?
Deconsolidation often gets a bad rap in financial media, for sure. But looking at the strategic rationale provided in this report, it is highly focused on capital efficiency.
How so?
Well, think about it. When Plenitude is fully consolidated inside Eni, it has to fight for internal capital allocation against a highly profitable deepwater oil rig in Angola.
Oh, man. Yeah. The oil rig is going to win that fight every time.
Exactly. The return timelines, the margins, and the risk profiles between solar panels and oil rigs are completely different. By deconsolidating, Plenitude gets a standalone, highly efficient capital structure.
Meaning they manage their own money.
Right. They can go out and tap into dedicated green financing pools, issue their own debt, and move at the agile speed of a renewable tech startup, rather than a legacy oil major.
Oh, I see. So untethering them allows them to secure cheaper capital because, like, ESG-focused funds can invest directly in Plenitude without having to compromise their mandates by buying shares in a parent company that pumps millions of barrels of crude oil.
That is the exact mechanic at play, and it is really fascinating to contrast that financial repositioning with what Enilive is doing.
Because Enilive isn't deconsolidating.
No, Enilive isn't relying on financial restructuring at all. They are executing a hyper-aggressive physical expansion on the ground.
What does that physical expansion look like operationally?
They just signed a major agreement to acquire a network of 320 OIL brand service stations from Prax.
320 stations?
Yep. They are literally buying up the retail mobility footprint across European markets to ensure they have physical points of sale for their own products.
Vertical integration.
Exactly. And simultaneously, they are making final investment decisions, or FIDs, to construct new biorefineries in Sannazzaro and Priolo.
Just to clarify, for anyone tracking infrastructure projects, a final investment decision is the absolute point of no return.
It's the green light.
Yeah, it means the board has officially signed the checks, committed the capital, and is breaking ground.
It is the ultimate indicator of strategic commitment. They aren't just talking abstractly about next-generation fuels. They are pouring the concrete to build the infrastructure required to process them.
But, funding all of this, buying 320 service stations, breaking ground on massive biorefineries, drilling in Côte d'Ivoire, it requires an ironclad balance sheet. And the broader macroeconomic environment isn't exactly friendly right now. So let's look under the hood at the cost and margin profiles. What specific operational threats did management flag in this report?
The clearest place to see those crosscurrents is within the refining and chemicals segment, which operates under the Versalis brand.
Right.
Refining actually posted a notable turnaround this quarter. They reported a positive pro forma adjusted EBIT of 0.08 billion euros in Q2.
Okay.
Now, that might seem really small compared to the billions we discussed in E&P, but it represents a massive reversal from the operating losses they were bleeding previously.
So what flipped them from red to black?
Two primary factors. First, better operational availability. They finished a series of planned maintenance turnarounds, meaning the facilities were actually online and running instead of just sitting idle.
Always helps when the factory is actually turned on.
Exactly. And second, a broader improvement in the refining margin scenario. The standard Eni refining margin, or SERM, settled at $8.3 per barrel, which is a really significant jump from the $4.8 they were seeing a year ago.
But the report wasn't entirely optimistic there, right? Management actively flagged that those margins were capped, meaning they sort of left money on the table.
They did. The headwinds in refining are severe right now. Management noted that the refining margins would have been much, much higher if they weren't being actively compressed by soaring global shipping costs.
Which is affecting everyone.
Right. But crucially, they were also compressed by a narrowing differential between heavy sour crude and light sweet crude.
Okay. The report puts a lot of weight on that crude differential, but I will admit that always feels a bit opaque to me. Like, oil is oil, right?
Not at all.
Why does the price gap between two specific types of unrefined crude suddenly squeeze a major refinery's profit margin?
It is the core economic driver of a complex refinery. Heavy sour crude is thick, it's full of sulfur, and it's incredibly difficult to process. Because it is so hard to refine, it trades at a steep discount on the open market. It's cheap. A company like Eni spends billions of euros upgrading their refineries with specialized, highly technical equipment so they can buy this cheap, difficult crude and crack it into high-value fuels.
Okay, so it's like buying a fixer-upper house because you're the only one with the tools to fix it. Their entire competitive advantage is their technological ability to buy the cheap stuff.
Precisely. Light, sweet crude, on the other hand, is really easy to refine, so it is expensive. Normally, the price gap between the cheap stuff and the expensive stuff is wide, and complex refineries make an absolute fortune operating in that gap.
Buying low and refining high.
Right. But recently, due to shifting global supply dynamics, that price gap narrowed. Heavy crude got more expensive relative to light crude.
Oh, I see.
Suddenly, Eni's raw material costs spike, the advantage of their billion-dollar complex refinery basically evaporates, and their margins get crushed.
That makes perfect sense. The raw material advantage just vanished. And fighting that kind of margin compression in refining isn't cheap.
No, it isn't.
If they are funding a massive transition and upgrading legacy plants, how stretched is their bank account right now, especially with the chemicals division also facing pressure?
Yeah, the chemical side is facing an even harsher reality. The report points to sluggish, broad economic activity and structural industry headwinds across Europe.
European manufacturing is having a tough time.
Exactly. European chemical plants are facing intense competitive pressure from international players who enjoy a drastically advantaged cost structure, meaning competitors in regions with much, much cheaper access to energy and raw feedstocks.
Like the U.S. or the Middle East.
Right. Now, to their credit, Versalis did manage to slash its operating losses by 65% this quarter by aggressively restructuring and shutting down underperforming plants.
Trimming the dead weight again.
Exactly. But it remains a highly vulnerable spot, which makes the balance sheet data you asked about even more critical. In the first half alone, Eni deployed 3.7 billion euros in organic capital expenditure.
With 3.7 billion going out the door, plus the transition investments we talked about, what does their leverage actually look like? Are they drowning in debt?
This is perhaps the strongest part of the entire earnings report. Despite spending that 3.7 billion euros on organic capex, Eni's pro forma gearing ratio is sitting at a historic low of just 10%.
Wow, 10%. Let's frame that gearing metric, because 10% leverage for a massive asset-heavy energy major is almost unheard of.
It really is.
Think of gearing like a homeowner's mortgage relative to the equity they have in their house. Eni is operating like a homeowner who is almost completely paid off their mortgage.
That's a good way to put it.
They have virtually no debt burden weighing them down. And because they have no massive mortgage payment, they are using their massive free cash flow to completely remodel the house, which is funding the transition businesses, while simultaneously buying a brand new car, which in this case is their massive share buyback program.
The financial mechanics of that analogy hold up perfectly. Management's guidance for the year was a gearing range of 10 to 15%.
So they're at the very bottom.
They are sitting on the absolute floor of that range. That near zero leverage is the exact mechanical lever management is pulling to safely execute that 3.4 billion euro share buyback.
Because they have the cash and no debt stopping them.
Exactly. Because they generated 7.3 billion in operating cash flow and their debt obligations are negligible, they can fully fund their multi-billion euro capital expenditures, restructure their struggling chemical plants, pay the dividend, and still have a mountain of excess cash left over to aggressively buy back their own stock.
Which is great for investors.
It is. By reducing the number of outstanding shares, they increase the value of the remaining shares for the retail investor, all without adding an ounce of risk to their financial stability.
It is a textbook masterclass in balance sheet efficiency, honestly.
Yeah.
So bringing this all together, what is CEO Claudio Descalzi actually signaling to the broader market with this specific earnings narrative?
The overarching thesis from the CEO is that execution is outperforming the macro environment. Eni isn't just passively riding the volatility of global oil prices.
They aren't just sitting back.
No, they are actively forcing value through rigorous portfolio management. They are proving they can scale E&P to fund the next growth phase, fast-track the operational footprint of their transition businesses, and maintain absolute financial discipline.
And what does that mean for the person holding the stock?
Crucially for the listener, management is committing to a highly shareholder-friendly policy, returning 100% of any upside in cash flow back to investors in high-price scenarios.
Oh, wow.
If oil spikes or refining margins unexpectedly widen, that excess cash isn't going to bloated internal pet projects. It is going straight into buybacks and dividends.
That is a massive vote of confidence from management in their own cash-generating durability. But before we wrap up this deep dive, I want to leave you with a final provocative thought.
Okay, let's hear it.
It is buried right at the very end of the strategic development section of the report. We've spent this entire time analyzing oil barrels, LNG contracts, and biorefineries. But there is a quiet, really aggressive pivot happening in the background. Eni is physically entering the critical minerals value chain.
Yes, the strategic acquisitions in the Americas are a major signal.
Yes, exactly. Eni just took a 25% stake in a lithium project in Chile and an 11% stake in a graphite project in Canada.
Which are purely battery material.
Completely. And if that wasn't enough of a pivot, they formally established a joint venture with the UK Atomic Energy Authority to provide industrial expertise for fusion energy development.
That completely redefines the scope of their long-term capital allocation.
It does. It's wild. So as you digest these massive oil profits today, I want you to ponder this. The legacy oil majors are no longer just putting up a few solar panels to balance their emissions. They are quietly, methodically buying up the global battery supply chain and physically funding the research for nuclear fusion.
They're becoming something entirely new.
The very definition of what constitutes an energy major is fundamentally transforming right in front of us, and this earnings report shows exactly how they are paying for that transformation. That wraps up today's analysis of Eni's Q2 results. Make sure you follow the show for daily earnings coverage so you never miss a breakdown of the balance sheets driving the market. Until next time.